Inflation is a fact of life. It is the rate at which prices for goods and services increase over time. As prices rise, our money buys less. This erodes our purchasing power. In Canada, inflation is currently at 2.3%. While this may seem small, it adds up over time. The situation is even more pronounced in the US. In recent months, the US has implemented a series of tariffs on goods from various countries, including Canada. These tariffs, essentially taxes on imported goods, have added another layer of complexity to the inflation story. The stated aim of these tariffs is to protect American jobs and industries. However, critics argue that they are counterproductive, leading to higher prices for consumers and retaliation from trading partners. In March 2025, the US slapped a 25% tariff on almost all Canadian imports. While some of these tariffs were later rolled back for goods compliant with the new USMCA trade agreement, the impact was immediate and significant. Canadian businesses faced higher costs, and consumers on both sides of the border felt the pinch of increased prices on everything from cars to lumber. These tariffs have had a ripple effect throughout the Canadian economy. The uncertainty surrounding trade relations with the US has dampened business investment. The Canadian dollar has weakened against its US counterpart, making imported goods more expensive. And while some sectors have benefited from increased exports to countries outside the US, the overall impact on the Canadian economy has been negative. The combined effects of inflation and US tariffs are being felt by Canadians across the country. Wages are not keeping pace with the rising cost of living. Families are finding it harder to make ends meet. And the economic uncertainty is causing anxiety for many. The labor market, a key indicator of economic health, has also taken a hit. In March 2025 alone, Canada lost 33,000 jobs, and the unemployment rate jumped to 6.7%. While some of these job losses can be attributed to temporary factors, the ongoing trade tensions and inflationary pressures are expected to keep unemployment elevated in the coming months. The housing market, a perennial concern for Canadians, is also feeling the heat. Rising interest rates, coupled with the general economic uncertainty, have cooled the housing market in some regions. While this may offer some respite to those struggling with affordability, it also raises concerns about a potential downturn in the real estate market. Despite these challenges, there are steps Canadians can take to mitigate the impact of inflation and protect their financial well-being. The key is to be proactive, informed, and adaptable. Start by reviewing your budget. Identify areas where you can cut back on non-essential spending. Look for deals and discounts. Consider switching to generic brands for some items. And explore options for reducing your transportation costs, such as carpooling, public transit, or cycling. Managing debt is crucial in an inflationary environment. High-interest debt can quickly erode your purchasing power. Consider consolidating your debt, negotiating lower interest rates, or exploring balance transfer options. And be wary of taking on new debt, especially if interest rates are rising. Finally, don't neglect your long-term savings goals. While it may be tempting to dip into your savings to cover rising costs, it's important to maintain a healthy emergency fund and continue contributing to your retirement savings. Explore different investment options that offer protection against inflation, such as real estate, commodities, or inflation-protected bonds. Navigating the choppy waters of inflation and economic uncertainty requires vigilance, adaptability, and a proactive approach to personal finance. By staying informed, making informed decisions, and seeking out opportunities to save and invest wisely, Canadians can weather the current storm and emerge stronger on the other side.